Joining me now to talk more on the markets is Kathy Entwistle, Managing Director at Morgan Stanley. Kathy, good to see you. So you say that market cycles are the key theme right now for this market. You say we need to trust the cycle. So how can history be our guide here when we're talking about unprecedented events?
Well, every time we have an unprecedented event, it's unprecedented. And it seems that there are these cycles that continue to repeat and patterns that we can find in the markets and the economy. So what we're looking at is the fact that markets are coming into a recovery. And we know in the past when we're coming, out of a economic recession and into recovery, we can see the small caps and dividend paying value companies paying are the best place to place clients' money or to make that shift at this time. So that's what we're basically looking at, just making that small shift, understanding that the NASDAQ is taking a pause and Russell 2000 is starting to really ramp up. And I think that's to, the earlier point that we are in this rotational cycle.
Now you see the risk of one more drawdown before the end of the year. How big of a drawdown are you expecting, and what might the catalyst be for that, Kathy?
Alexis, that's a great question. Not necessarily sure how big the drawdown will be. We certainly had our largest drawdown, I would imagine, back in March. However, anytime there are dislocations in the market, that's when we have to take opportunities, and that's where the money is to be made. So if we see 5 or 10%, even that is enough to say it's an opportunity to buy at a discount, get your money invested into the market and take advantage of that, because we see next year as very favorable for the markets. We are 12 months looking forward bull on the markets, and we think that this is the time to take advantage of it. Now, what could cause it? At this point, we're getting so much great news out about vaccines and recoveries, and we see that the businesses and our economy can open up more broadly next year. So that's all positive. The only thing that I can see right now hanging out there that's a true negative that can bear down on the markets is increasing COVID cases and deaths. And if it just expands even greater than what we're seeing, we can see that pullback. And if that happens, take it as an opportunity to invest in those names and those areas of the markets that we like.
What about outside of equities? I'd like your take on the bond market, because the 10-year Treasury bond, you say it looks mispriced over the 12-month view. How so?
Well, just the idea that right now, in terms of, we think we want to keep our clients short in the bond market right now. We don't want them to go out longer, because we think that those prices are going to, the interest rates will go up and fairly quickly. Usually, if you look at the past two, interest rates do move pretty quickly. What do we say? They go up on an elevator and come down, or they go, come down on an escalator. But in any case, what we will say is, be careful about that. Don't get caught in that. Don't have long bonds, because if you're invested in long bonds, you're going to get hurt. When interest rates go up, bond prices go down. So that's what we're trying to avoid for clients.
Back to equities now, and your forecast for the S&P 500. You're forecasting 10% upside. That's pretty big over the next 12 months, with the backdrop still being this pandemic. What's going to get us there?
What's going to get us there is the economy opening up, opportunity for people to go out and spend money, for businesses to, to create business. And for some of those companies that we're looking at now, the, back to work companies, the economy is opening companies, we're looking to see that accelerate. And that's where our clients are going to do well.
What about hopes for a stimulus? Have investors just brushed that aside, and if we get stimulus, that's going to be icing on the cake? Or do you think that they're really banking on something coming down the pike in the coming, I want to say weeks, but maybe months after Biden takes office?
Yeah, I think just because right now there's a little bit of miscommunication or lack of communication between, old and new. There are some issues there. However, everybody's expecting a second stimulus package. We all know that it's coming eventually, although it's sort of pulled away from the market a little bit. If there was any indication that it might not happen, the markets could drop again. That would be another reason. But I would anticipate that would give a little boost, even if it's a short-term boost to the market, just from a positive standpoint. We're seeing a lot of quick reactions, whether good or bad news is coming out.
Mm-hmm. Certainly, this is not a normal year by any stretch. So I'm wondering if you're expecting to see a Santa Claus rally. Are you expecting money that's been sitting on the sidelines to flood back into this market come January?
I do think that we're going to see people go back and spend again. In terms of we've all been home for so long, we haven't been out and about as much as we usually are, and we're all interested in doing that. It's funny, somebody was reminding me of, a century ago with the Spanish flu, and what came immediately following. It was the Roaring '20s, right? So after World War I, Spanish flu, everybody just couldn't wait to go back out and just celebrate and be together and enjoy each other. And I think we're going to see that in some form as well after we're past this COVID-19 really challenging time.
Yeah, from your mouth to God's ears. Kathy Entwistle, Managing Director at Morgan Stanley. Thanks, and have a good Thanksgiving holiday.
To Alexis, thank you.